This is Team 7 for Cadbury Schweppes. In 2002, Sir John Sutherland, CEO of Cadbury Schweppes, was faced with a difficult decision of whether to acquire Adams. This was a highly competitive environment where Adams was about to be sold by Pfizer, and analysts estimated at a cost of at least $4 billion to acquire. Nestle and Wrigley's and other leaders in the industry were also interested in purchasing. And the relative value for Cadbury Schweppes, their total assets in 2001 were $7.4 billion, so this would increase their total assets by over 50%. The purchase price, they projected about 2.3 times the annual sales for Adams, which was a little bit on the high side, so they wouldn't be willing to pay much more. In terms of unique synergies, analysts estimated a standalone value of Adams of $3 to $3.5 billion, with potential synergies of up to $3.6 billion. However, more realistically, probably the total value with synergies would be about $5.6 billion, optimistically. There are concerns about Cadbury Schweppes' ability to manage the acquisition and to execute it effectively. And the current theory of value creation was that the Cadbury Schweppes would continue to grow sugar-free gum in the US with high velocity points of sale and process capabilities. In terms of foresight, insight, and cross-sight, Cadbury Schweppes was hoping to focus on growth factors, specifically gum, become a global leader in confectionery with 26% market share in gum, positioned to challenge their biggest competitor, Wrigley. They would also have the ability through this acquisition to expand their focus into Latin America, Middle East, and other developing markets. For insight, Cadbury's strategy was focused primarily on US carbonates and UK confectionery. We view this acquisition as a complementary addition to their current strategy. In terms of cross-sight, Cadbury is focusing on building a robust and sustainable business through organic and acquisitions. In order to recapture our invested capital and take full advantage of the bargain we have identified in Adams, we would recommend starting first with the easy wins. This will help to show a quick return on our money. These would include consolidating the procurement of ingredients and reducing broker commissions, moving to the higher priority big wins and what we've identified as the most valuable unique synergies amongst the two companies, penetrating the US sugar-free gum market, leverage Adams' point of sales in the US and vice versa, leveraging Cadbury points of sale internationally, and headcount consolidation and other forms of cost integration to improve operating margins. Thirdly, prioritizing the elimination of duplicate manufacturing assets, revitalizing the Halls brand, and expanding the breadth of product distribution globally. In terms of the synergies, some benefits include increased access to established and emerging markets, increased benefits from economies of scale, and synergies in the supply chain. Some potential negatives that we identified were previous track record of inefficiencies and consolidation, including the merger between Cadbury and Schweppes itself, as well as uncertainty in employee retention. Specific synergies, including Synergy 8, one of the things that was mentioned in the reading is that there wasn't strong leadership, and it takes strong leadership to manage employees and keep key personnel from leaving due to uncertainty and other integration factors. This particular synergy was estimated at up to $67 million. Additionally, Synergy 2 is optimistic, hoping to have 2 hit products comparable to Altoids or Cream Savers and achieve $100 million before 2012 seems like a lofty, lengthy, and optimistic goal. We are skeptical of Cadbury's ability to integrate Adams in a timely manner given their history and decentralized organizational structure. We are also concerned about the lack of experienced leadership on the Cadbury side and their ability to manage necessary investment levels in newly acquired brands and new product launches. So, should we support the acquisition and at what price? Again, Cadbury's strategy historically has been the US carbonates and UK confectionery markets. we feel that the acquisition of atoms will be complementary and synergistic to the current strategy. Therefore, we recommend and support the acquisition at a cost of no more than $4.3 billion. While there will be some unique synergies to this acquisition, by paying more than $4.3 billion, we would not be able to recapture those synergies with the acquisition.